I'm going to go ahead and pass it off now to our presenter, George. You can go ahead and share your screen, George.
All righty. Well, I get that ready. Let me go ahead and share mine. Get into presentation mode. Okay. Good evening, everyone. Thank you, Paolo. We're very fortunate and lucky to have such a great resource like the Berwyn Development Center. I can't say enough good things about the work that you guys do there. So I strongly recommend everyone to get to know the team. They're awesome, and very delighted to be a part of this, which I've had high hopes for to get this going. So today we're going to be covering some business finance basics presented by myself. I've been a part of the Wintrust family now for just over 5 years. I have a total of 15 years. A little bit about myself is I have a little bit over 15 years of experience in business banking. I've helped, all walks of life. My father was an entrepreneur. I involuntarily started working for him when I was 12. So that's kind of how I got my foot in the door. And then my mom was a banker. So this is just kind of hand in glove situation for myself. I love what I do. I love talking to business owners every day from all types of industries and all kinds of walks of life. I have a big, my background primarily is in SBA finance, business lines of credits, term loan financing, real estate acquisition, construction, and equipment loans. So really, I kind of cover the gamut of traditional and SBA finance. What I'm hoping is that I provide a high level overview of the landscape today. And so we can kind of cover a lot of ground from a standpoint of if we're just starting off our journey into entrepreneurship, getting the 101 in the basics is what I'm hoping to accomplish with this. So let's begin. Business financing. What is business financing? It's a way to get money you need to start, operate, or grow your business. There's a couple different principles of how you go about doing that. Equity financing versus debt financing. If anyone here is a big fan of Shark Tank, what you're watching on TV is equity finance. People go up there, present their plan and say, hey, this is what I've made, or this is what I'm going to do, whether it be a service industry or a product. And the sharks basically offer them financing through shares of ownership of the company. So that would be equity financing. An example of debt financing would be when you formulate an idea and you come to a financial institution and ask for a loan to help start the business. Those are two fundamental differences between the two. Financing working capital versus financing fixed assets. So we're going to take a deep dive into what those four kind of principles are. We're going to start by covering the do's and the don'ts. I always find as a banker, it's all about preparation and knowing kind of the steps of where to begin. So once you've had an idea, if you're like most of my business owners that I've come across, you come to a point in your life where you say, I want to go off on my own. How do I go about doing it? Okay, well, we start with, are you going to be investing your own money? Are you going to earn the right to borrow? Are you going to show profitability? Are you going to understand and keep working capital? Are you going to be lean on fixed assets? Are you going to match sources and uses of funds? And so when we look at, kind of some overarching, I would say mistakes, there's typically common practices that help us avoid from, opening our doors without enough money in our pockets or not having enough in our savings accounts. So really the principles come back to the same things over and over again. It's understanding your financial statements. So if anyone here still balances a checkbook like I do, a lot of the same principles apply. My mom and dad showed me how to balance a checkbook when I was a very young lad, and I've kind of kept to the same principles of that going forward in life. When I talk to my business owners, we always start on budgets and understanding our financial statements and what they say about our business. We understand what collateral options are. Collateral may be multiple different things, whether it's real estate, whether it's the business assets, whether it's a primary home. Collateral can look like a lot of different things for the type of business that you're looking to open. And the banks and the financial institutions are going to have a analysis of that collateral. You're going to want to understand the risk and costs of the loan types. Every loan type has a different kind of term set, and they're pretty prevalently common. And for the most part, I know ever since COVID, there are different alternative types of financing that have now since blossomed. But for what the intents and purposes of this call is going to be, it's going to revolve around mostly traditional conventional finance. So that way we get through that. Grants are not a part of what we're going to discuss. The unique programs that Paulo was talking about earlier, those are typically not meant to start up your business. Those grants are for businesses that have been in business, have been weathering the storm through COVID. So when it comes to startup finance, that's why there's really no grants out there. There are some programs to help assist with, being in business for a few years, which I have later on in the slides, but for startup purposes, grants are generally not available for us. Shopping around, we're going to talk a little bit about, what to look at from the landscape and what the options are. And we're also going to talk about getting expert advice is probably my favorite component about this, because a lot of business finance is about matchmaking. It's about understanding where to go with your request and who to ask and why. Choosing your lender is probably as important as everything else in life, because you really want to go with subject matter experts. It's like finding a mechanic. If you have a really nice European car, generally you want to take it to someone who is a specialty when it comes to that, because they're going to know the ins and outs better than just a generalist. So you want to be very selective when it comes to, where you're going to be applying for your business loan. All right. So now that we kind of, covered, all right, what are the do's and don'ts? How do we get ready? How do we know that we're preparing ourselves for success? Well, we start with a business plan. Business plans generally are 1 to 2 years, especially if we're looking at SBA finance. There's plenty of templates out there. Some are free, some are, paid for. I have some examples of some business plans later on in the slide, but you want to start off with your idea on pen and paper and start with what are you going to do? I call them 5 W's, the who, the what, the where, the why, and the when. So once you cover that aspect of the business, then we can start to detail out, what you can afford, study your financial statements, checking your credit report, establishing your collateral options, and then showing your equity contribution and researching your financing options. But it's all built off the backbone that you've done your homework about that industry type. So if we give you an example, if I'm working on a loan for a landscape architect and he's wanting to start up his business, I would like to see 2 years of who are his clients going to be, why does he want to start this business, how is he going to go about going to market, why does he think his business is going to be different than anyone else's, and benchmarking that over the course of 2 years' time. So that way it gives me a clear understanding of how we're going to about putting this loan application together to get through underwriting. The business plan, the common elements of the loan package that I'm alluding to is that business plan, is your financial statements. In this example of a startup, you're not going to have current, so you're going to go based off projections. But if you have a business right now that's been in business for more than 2 years, you want to be able to provide those. So you want to be able to provide not only your tax returns, but your financial statements. So if you're utilizing software, like let's say QuickBooks, you're going to want to have a year-over-year comparable available for the bank or financial institution person that you're going to be talking to, because they're going to want to know in real time exactly what the business is doing. They want to know the health and vitality of the business. So you want to have that prepared. A personal financial statement should be something that everyone does periodically. I look at it and say it's almost like a annual checkup for your health exam. You're going to want a personal financial statement that lists your assets and your liabilities. So it gives the banker an understanding of who you are and how much wherewithal you have financially, and also for yourself. So that way you can start to see, okay, what's my affordability? What's my risk? How am I going to go about doing this? Many times I've seen where someone has started a business or has utilized personal finances to keep their business alive. That's something that happens after the fact in my world a little bit too often for my liking. Typically, if you're looking for a loan, the best practice is you always want to be in advance of the 8 ball. You want to make sure that you have all these in order before you actually come to the bank, because once if you've exhausted options, it's really hard then to kind of work backwards. So all these things should be done in preparation of meeting with your advisor representative, and then your personal, your business tax returns. A caveat to that, an asterisk. So if anyone here has a business where they're in a partnership with more than 1 or 2 owners, anytime there are multiple owners in a business, the bank and financial institutions generally require anyone with 20% or more ownership to be involved in that loan application. So if the person decides that they don't want to apply, there's kind of no moving ground there, because if there is more than 20% ownership, we need them to be included in the application. So please keep that in mind. We can talk a little bit more about that. There is some nuance to it. So, but yeah, anytime you look for a business loan application, anyone with 20% or more ownership will be somebody that the bank asks for. Guarantee. What are the elements? So sources and uses of equity contribution, your credit reports, again, that's for all the individuals involved, collateral. In the event of, if we're buying something such as real estate, there should be a purchase agreement in place. Appraisal contracts and estimates, that's all kind of in the process of underwriting. So if someone comes to me and says, George, I really want to buy this building, I don't expect them to come to me with an appraisal, but I do, anticipate them coming to me with a purchase agreement. So I know exactly how much money that transaction is going to cost. It tells me when they're planning on closing, and it tells me a little bit of framework of who's involved. So what entity is going to be buying it, what have they agreed on, and so from there we can get into underwriting, as long as we've had that previous slide. If we've collected the tax returns that we've needed, if we've got the interim financial statements, then we want to have at all times 100, as close to 100% of the application to get into underwriting. That's always best practice when it comes to applying. You never want to come in with 75, 80%, because then you're working behind and underwriting can feel like very daunting. So you want to have conversations ahead of time with your bankers before you get into a purchase agreement, because it gives us ample time to kind of digest and put the loan application together. So qualifying for a loan. What are the criteria for qualifying for a loan? So this is a really fun slide for me. A good credit score. Good credit in this country. Credit is one of those things where, depending on your institution, this to me has always felt like it's a moving target for people, because there's a bunch of resources out there today, and institutions utilize all kinds of different data sets to be able to analyze a credit score. So score is much as important. There's an easy thing to Google called the 5 C's of credit, where you can look at and see what actual credit score means, and credit history and credit. So credit isn't just about the number itself, but it's also about the performance and the character of how you've utilized that credit in your past. And so when I look at it, a good credit score can be 620. A great credit score can be 800. Have I seen loans approved for under 620? Yes, I have. It just goes back to blending the story with the credit. So equity contribution. Anytime I get a call from a prospect looking for a business loan, equity is always one of the first questions that I ask. If it's a real estate transaction, you can expect to pay or to inject anywhere between 10 to 30% down for typical SBA and conventional loan rates. And then for equipment finance, you can look at 10% to 20% down. Really for lines of credits is probably the only one that we don't necessarily look at equity contribution. We look more so for a cash flow perspective, but we can get a little bit more into that later on in the slides. Repayment ability. So that's where that cash flow projections are going to come into play. How are we going to be able to repay the note that we're taking out? And then loan to value ratios. Those are typically for real estate acquisitions or business acquisitions. So this happens pretty common in my world where someone is looking to buy someone else's business. Typically, you're going to want to have, depending on how we formulate it, a number that you've contracted and said, okay, if I want to buy, let's say, a salon and the seller wants to sell it for $1 million, you want to have agreed to a price before you come to the bank, but you also want to have that benchmark with somebody. So there's an array of services out there that'll do evaluations for a business if you're looking to buy one. If not, the loan to value ratio primarily is driven by assets such as real estate and equipment financing. Excuse me, I might be a little sick. So if I'm going too fast, like I said, I'm going to spend plenty of time at the end of this for Q&A. I'm just dealing with a little bit of a cold, so bear with me if in case I lose my voice a little bit. So what are the financing options for a startup business? So equity, going back to that first one that we talked about. So that's where, you have an investor, whether it be angel investing or true VC, or just even a silent part. If in the event that you choose to sell portions or shares of your business for a monetary fee or monetary price. So if you were to say, I'm going to give up 10% of my company for $100,000, that would be you using equity to finance your business. Sweat equity, that one was my dad's favorite. That's where you put your time in to be able to cover the costs of overhead to say, I'm going to get this business up and running. I'm going to work after my daytime to, put together. My mom would make little socks around this time of year for Christmas to sell. That's sweat equity. That's you spending your time to be able to launch your business. Business credit cards, which right now in the environment that we're in with rising rate environments, is something that scares me because business credit cards are one of the most common ways that I've seen business owners get their business going. But you have to be very cognizant about business credit cards. Typically, they can go anywhere from 18 to 30% interest rates. So it is a common practice, but it's also a very expensive practice. That is probably one of the most expensive ways to start your business or maintain your business. And then family. So you can go to friends and family, or I think there should be a little asterisk on this one too, where bootstrapping is another name or a term that I've heard in the industry where you've utilized your friends and family or yourself and said, I'm going to take my life savings and I'm going to put it towards this business in order to grow or to continue. That's known as family finance, which doesn't have repayment terms typically. Now, if you're looking for a loan, where are you going to go? So banks, credit unions, regional lending organizations, you're going to look at an array, and the landscape is long and deep, and there's so many options out there. But historically, it's been the banks and the regional lending institutions. And you're going to see that financing is getting the money you need to start, operate, or grow your business. Starting with key points to remember, sorry, let me back up, is that you're going to need to know what that number is in order for you to formulate. So you're going to start with a budget. You're going to keep sound bookkeeping for the basis of all management, purchase and learn how to use financial management. So I was alluding to QuickBooks earlier. There's more than one QuickBooks. There's plenty of new software out there that helps business owners manage their business in real time. I know that Square and PayPal and all the fintech companies out there are starting to integrate into POS terminals and be able to allow business owners to take a pulse of their business in real time. The three statements that are prevalent in all that software are the balance sheets, your cash flow statements, and your profit and loss statements. We're going to take a deeper dive into the three of those later on. But they provide the story to describe the business of what's going on in the hood. And I will say that the story is just as important as the financials. Separate your personal, your business records and funds. So one of the things I've seen most recently is commingling of funds. So remember that your business is here and your personal is here. Anytime a business owner starts to purchase something for the personal in the business and the business in the personal, that's commingling of funds. And that makes it harder for the banker or the financial institution representative to do their job so that they can be able to say, this person is making, let's just throw out some examples of rough numbers. If we have a $100,000 revenue business, but we've commingled funds from our personal, it could be hard to unpack that and say, okay, how do we know how much the business is actually making or spending? And so really separating those two so that they're clear and understandable is very important at the start of your business or at the start of the year. Sometimes I use it as a New Year's resolution for some of my business owners when they've gotten off the ball and allowed that to take place. Factors that affect your ability to get a loan. Again, this goes back to what we talked about earlier, is your ability to get a loan, credit score, your equity contribution, your repayment ability, and your loan to value ratio. So that one's a little redundant. So financial statements are reports about a business's health and cash flows. So back to the three, you're going to be hearing these a little bit. If you've been in this journey, you've heard of these three. Balance sheet, cash flow projections, also known as the cash flow statement, and then the P&L or income statement. So here we have an example of a balance sheet. It's pretty basic, and it gives us a clean understanding of what the business has versus the business's debt. The totals should equal the same on both sides. So on the left, you have your assets. So those are your cash, your equipment, and your inventory. On the right, you have your liabilities, which is $20,000, meaning a loan of $20,000, your owner's equity of $35,000, and that equals 55. So in this example, the owner utilized $35,000 of his own money, right? So his or hers, and then took a loan out for $20,000. So total, the business owes the owner $35,000 and the business owes that loan of $20,000. So that equals 55. Now he chose to utilize, they chose to utilize this cash in a breakdown of keeping $10,000 liquid, $25,000 for equipment, and $20,000 for inventory. So the basics are the same for any business, is how much did we have in terms of assets and how much do we have in terms of liabilities. So how you categorize them, a good accountant works this beautifully, artistically, but they should always reconcile anytime we're dealing with our balance sheet. So now that we got an understanding of assets and liabilities, this one to me is my favorite one. This one is the one that tells me how you make money. And why the business is so great and healthy and understanding. That's our cash flow. This to me is the lifeline of the business. There's two primary definitions. It's balance of cash received less the amount of cash paid over the period of time, or the much easier version, money moving in or out of a business account. So a financial statement using assumptions to forecast is a cash flow projection. So that's when money's coming in, money's coming out. It's telling us in the future how money's going to come in and money's going to come out for a specific period of time. And then it's going to project whether cash receipts and flows will be sufficient to cover the money coming out. So every industry has kind of a certain flow to how cash flows historically have behaved. But what they do is they allow you to know when and how you're going to utilize this. So they're used to set sales and expense goals. They're used to determine break-even points. How much money am I going to need to cover my overhead and find that breaking point so I know how much sales I need to do in order to keep the lights on. It allows me to allows companies to know when to plan for purchases or replacement of purchases or expansion. It lets them know, okay, if I can count on this money in the future coming in, and I know that my overhead is X, maybe I can go spring for the new computers that I've been wanting to get everyone. And it really determines your seasonality too, because it allows you to set, a year or two in advance to say, okay, I know that in this time of year, we all live in Chicago. We all know that weather has its rhyme and rhythm here. So this is a lull for real estate development, because we know that we just can't build as much in the cold. So there's lulls in the seasonality. So that's an easy one to determine here for Chicago, is that we deal with our winters. But I would say we do a better job than other cities in terms of keeping the lights on, keeping things going. How else can they help? Well, they can track liquidity when accrual accounting masks cash reality. So if anyone here utilized an accrual method, where let's say you sent out an invoice for something that you sold, $20,000, and you put it in the books, accrual meaning that I count that full invoice at the time of placement, but the money doesn't get paid on $20,000 all at once. It gets paid over the course of 3 or 4 months. And so now what cash flow projections can do, they can go back and really tell us, okay, even though there's nothing wrong with accrual method reporting, this will allow us to say, okay, even though that billing of the 20,000 came in, the money didn't actually hit the account and spread over 3 months. And so it allows us to look at it and say, did that $20,000 cause any headaches because it was spread out? It helps you determine the need for financing. So cash flow projections are one of the easiest ways I can determine whether a business needs a line of credit. So if I gave you an example, if you were to say you were a wholesaler or retailer, you're buying inventory ahead of the time that you're going to sell it. And so if your product takes 2 weeks from the time of the day you bought it versus the time that you sold it, that would be a 2-week cash flow injection. So meaning that, you could look at it and say, okay, I need to be able to cover as much time as I can to cover that gap. So typically what us lenders like to do is not only look at that number, but also look at the advanced number and the historical number. So we're going to say, we need to get a good understanding of that flow so that we know how much money you might or may not need. And so that's why right sizing the number that you need is based off of the cash flow projection. It allows us to see how much you can pay. It allows us to see how much time you have to pay and future date that, so that we're very precise and exact with our analysis. And it shows the lender that you can repay it over the course of time. So here's an example of one. So this one's blank. You're going to look at your sources of cash when you first start. So you're going to work on the left all the way down the column that says opening balance, if you were going to do this exercise for yourself at home. So you're going to start with your cash. So the cash could be the money that you're starting with in your checking account today. You're also going to look at ARs. If you're looking at the line item by line item, beginning cash, cash sales, collections on AR. AR is accounts receivable. So again, that's if someone owes you money and you've said, okay, I can give you 90 days to pay. Well, how much have you paid, or how much have they paid and how much is still left? That would be known as accounts receivable. Interest income, that's money if you're collecting on money that you have out there. Loan received, equity contribution. So now that you have your total sources of cash, how are you going to utilize that cash? What's your operating? What's your overhead? Do you have 1099 employees, contract labor, wages? Do you have W-4 employees, payroll taxes? How much are they going to cost? Rent, phone, office supplies, utilities. Most of these are fixed costs. Depending on your business, you could have a lot of soft costs, but you're going to want to put those in there so that you could get a good idea as to what your monthly overhead is going to be. So it gives you that bottom number of the non-operating uses of cash. So how much are you left over at the end of the month? That number should be a positive number. That number is a negative number, we're in trouble. We need to be able to, unless we are an Uber of the world where people are just throwing money at us left and right, we can't operate with a deficit. We need to be able to operate with a surplus. And so that gives us an idea, and you can see how it continues to move month 1, month 2. This is the beginning of a projection. Typically I ask for, especially for startups, to prepare 2 years of projections. So that way we give us a short term and a long term. And it gives us a guiding post to say, where do we want to be in a year? Where do we want to be in 2 years? How much do you want to pay yourself? You know, most entrepreneurs get into this because they love what they do, but you also need to be compensated for it. So if you're deciding to do this and you have a day job and you want to offset or supplement income, you know, I think that that's something that you can utilize this tool to kind of say, okay, where is it that I can be in 6 months? Is that going to be enough to offset my income so that I can go and become an entrepreneur? So again, you can utilize an array of different software for cash flow projections. I have some examples at the end. A profit. So moving on. So that was our cash flow statement. Now we're on profit and loss. So the P&L measures revenues and expenses over a period of time. So it's going to take what we put in there. You know, generally, you know, we're looking at year to date, 6 months, quarterly. They track profitability, whether the business is making a profit on what it sells is the arching what a P&L tells us. It shows us how successful the buying and selling process has been managed. It measures the ability of your business to grow and repay debt service and support you. It says it's the most important report from your accounting software program. It is. I like cash flow, but this is equally as important. It gives us a full view of, does the business make money and where is it being spent? So how you get the basic formula of P&L? You take your sales, you subtract your cost of goods sold, that equals your gross profit. You subtract your overhead at your net profit. As a lender, that's the number that we all look at. How much money is the business netting after all things have been said and done? What is the business manufacturing from a net profit standpoint? The net profit pays for the owner's draw. So depending on, you know, owners wanting to take that and put it in their pockets, it pays for future expansion and equipment. It's principal loan repayment and income taxes. Hopefully not Porsches. I always say if you're gonna take your profits, an appreciating asset is generally what the rule of thumb. Depreciating assets, while they're fun, they generally don't help us. How do you do a P&L? If you have the right business accounting software. So again, I don't mind when I see someone utilizing a manual method. It's just, you know, when you're running a business, it's well worth the money to spend to utilize something, whether it's QuickBooks, whether it's Monday, whether it's a Salesforce application. It's worth the money to be able to offset that by having one of these software providers help you with that, because doing that yourself is extremely difficult and time consuming. So here we have some of the resources that I alluded to earlier. So one of the first places for our team to look at, and let me see, I'm going to make sure. I think I'm going to have to stop sharing in order to switch the screen. Or before I get into the actual websites, let me take a pause here. So we want to look at the questions, Paula?
Yes, I don't have any questions in the chat as of now. So if anyone,
copy of the slides. Yeah, we're gonna have a copy of the slides. You answered that one. Okay.
yeah, if anyone has any questions for George, now would be the time to drop them in the chat.
We'll give it a couple minutes. Okay, well, that goes through. I'm going to share mine. Okay. And then if we do get any questions, we can stop here. So Score, and I have worked with them in the past. They're an organization that helps individuals find mentors, tons of resources on this website, score.org, workshops across the United States. They help with everything. They have webinars as well. They have courses on demand, local workshops. So you can literally find pretty much any topic. One of the things that I really love about them is that they help with the business plans. And the business plans, how to write a business plan, avoid getting stuck. What they do is they make it an easy breakdown to say, okay, because I, the business banker, any banker that you talk to doesn't generally have the time. We're busy taking applications, getting them into underwriting, and getting them through. So that's why resources like this is something that's vital for a startup entrepreneur. Or if you've been in business, it actually also has a ton of really good insights. For instance, stories from women entrepreneurs. So again, I think this is one of my favorite sites and first places I go to for startup entrepreneurs, and also for people who have been in business. My second resource is my first resource is the SBA itself. Let me just pull it up here. So the SBA.gov, again, they do a good job from a standpoint of it gives you understandings into what each program does, what it looks for. So if you go onto their business guide, you can actually break it down from planning your business, launching your business, managing and growing your business. Typically, Wintrust is one. I think this is our second year in a row for being in the top 5 of SBA lenders in the Illinois state, and so we're very proud of having a robust SBA team. What the SBA allows for is lower equity down payment, so it's a way for entrepreneurs to get access to funds at a lower entry cost. There is some awesome promotional. So right now, the SBA has a promotion where if the request is under $500,000, there's no fee. So there are some unique things going on in this world. There's a lot to cover. I'm happy to do a call that'll break down any one of the types of loans that are out there, whether it be what's the difference between an SBA and a 504 loan, what's the difference between their express program, what to expect, what do the forms look like. So happy to cover that in a follow-up. But that's a first place to look at when you're looking at SBA finance, going straight to the source to see what it takes to get access to. Let's go to what I wanted was let me see. It's this second one. Okay, so if anyone's familiar, so we talked a lot about credit score today. So NerdWallet is one of the places I go to or send my clients to and prospects to go for information. NerdWallet was created, I believe, over 10 years ago. It's a great website full of awesome information. This one I selected because I know that grants are very top of mind for our business owners. They compile national information and they put it in one simple place for us to find. So that way we can say, okay, where are small business development centers, minority business programs? They'll break down pretty much any topic. What I really love is that they will talk about business, they'll talk about credit, they'll talk about, I must have clicked something else. So you can look at this website for an array of different reasons. But one of the things I like is that it will tell you, let me see, reviews. So they compile a list of best lenders, what to look for, minimum credit scores. Again, I'm partial to ourselves. I want you to come with a local bank, but in terms of getting a feel for the landscape, this is a good place and resource to go to. So you can find information about what's available for you and your business. Let's do one last one, which is QuickBooks. Looks like my links are not working in QuickBooks. So QuickBooks Intuit has done a really good job of becoming more robust than when it was first organized. So they're much more than just P&L statements. As you can see in their examples, it's touch of the finger where you can get information, invoicing, collection of money. The P&L and the balance sheet is just an aspect of their business, and they provide an array of different solutions. Really, the reason why we bring them up more prevalently is that without the financial information and statements, it's unfortunately very difficult for us as business lenders to be able to get into underwriting without having those questions. So that's why I wanted to make sure everybody's familiar with QuickBooks. So I'll stop there from a standpoint of those are the resources that you'll be getting. Looks like we might have a couple of questions.
Yes, they did get 2 come through, so I'll share them here. The first one is, I'm interested in expanding my small business. What's the first thing I should do?
That's interesting. So I would say first thing is to start with what exactly the expansion looks like. So if available, I would love to sit, if we were hypothetically speaking, the banker would ask questions like, tell me about your expansion. How have you been, what kind of business is it? What do you plan on doing? How much is it going to take to expand? What does the expansion look like for you from a time perspective? Because when I hear the word expansion, I hear, typically it comes with bandwidth as a business owner. How much is this going to increase your workload, and how do you plan to address that? So I would start with having the questions, kind of answered, and then from there extrapolating, going back to the slides. It's on, when we look at the business plan, it's kind of, anytime you're expanding, it's kind of like going back to square one and saying, what does this mean for me and my business? How much money is the expansion going to produce? How much is the overhead going to increase as well? And is it worth that expansion to be able to do? So am I going to be, if I'm taking out a loan to facilitate, this expansion, then will it make the profits that it needs to in order to do that? Yeah, and it is a lot of information. Again, this was intended to be overarching. Apologize if I was a little fast today, everyone. I do have the habit of being a little quick, but really, you're going to get a copy of this with my information. My email address is on the first slide page on slide number 8. Happy to answer your questions if you've thought about them overnight or in the next few weeks. I'm happy to set up meetings so that we can discuss in detail. Looks like, which financial program is best suited for construction? So construction, do you mind MTC properties? Construction in the sense of ground up construction, or construction like a construction company? General contracting. Company, got it. Okay. Yeah, so general contracting is like any other industry. What you're going to want to do is, what the request is for. So whether it's for working capital or equipment financing, it just depends. So if you've been in business for more than 2 years, you're available for conventional business loans. So you can go to any financial institution, show them your 2 years of business returns and financial statements, and say, hey, I'm interested in a line of credit or equipment loan. And they're going to be able to kind of diagnose, if we go back to those principles of what we look for: good credit, repayment, profitability, your cash flow projections, your collateral. Then you're going to be able to say, okay, we've got a good sense of being able to approve you. So as long as you come to the bank with those elements, then you're going to be able to say, okay, I will say though, the one general contracting You should definitely use your QuickBooks. I would say what the one wrinkle in general contracting is the accounts receivable in conjunction. If you don't have a cash flow projections, I would come to the bank or institution with your accounts receivable aging, because what that's going to be allow them to let you see is that's another form of collateral. How much are you, billed out, invoiced out? How much have you collected? Generally, if anything's over 90 days in your accounts receivable, that's discounted. So you want to really make sure that everything in there is accurate as possible. So I would definitely print out your P&L, your balance sheet, and your accounts receivable if you're in contracting, because generally that's where the most of your money to be paid is the jobs that you have out there that are waiting to be collected on. Because typically, in my experience, contractors have collected half up front and then half at time of completion. And that half at the time of completion can be 3 months, 6 months, depending on what you're doing. Obviously, supply chain issues and inflation have caused things to slow down. So that's what I would recommend doing when you go to the institution of your choice for application. And again, I'm working on 3 contractors at the moment, all walks of life. They could either be like the seasonal ones, like landscaping, and or tradesmen. So I'm happy to set up a meeting and discuss in details.
I think there was a follow-up question there about QuickBooks. I don't know if you touched on that at all. Do you have any tips or suggestions with QuickBooks, George?
Yeah, so the nice thing about QuickBooks is if you haven't been utilizing QuickBooks and you want to kind of get started, they've made it pretty seamless in terms of an API connecting to your bank account. So when you sign up for QuickBooks, it'll ask you to connect it to a bank account. They also offer banking services, but the nice thing is if you've been utilizing your bank with a business account, you can log in via their API so that it will extract the information from your bank. So you don't have to go back through every single month. It will automatically, once you allow it to integrate to your bank. Otherwise, you can also upload statements to QuickBooks the opposite way. So you can do either or to make it easy to kind of hit the ground running once you start implementing QuickBooks. But like I said earlier, QuickBooks does an array of things. It saves you money by freeing up your time. And when it comes to reporting, it's the holy grail when it comes to an application. We want to make sure that the information we've captured is correct, accurate, and it has all the elements that we're looking for from a perspective of the P&L, the cash flow statements, and the balance sheet. I think.
Does anyone else have any questions, follow-up questions to the information George has shared? This would also be a good time to share your own tips, tricks, resources, or experience. You have, several other fellow business owners, entrepreneurs on this call who you could learn from. So if anyone has anything to share or comments to add, please raise your hand, drop it in the chat. We'd love to hear.
So while we're wrapping up, where you can typically expect to find me is I'm available throughout. I concentrate my time in the Berwyn Cicero markets. If you'd like for me, I can come out, meet with coffee. My schedule is pretty flexible from a standpoint of accommodation so that I can meet you on your time. I know business owners struggle with their time, and most, bigger banks, not to, I've worked for Chase in the past and the bigger banks in the world. And so I know that their model isn't built for sending a representative to their place of employment. That's why I really love working with Wintrust. We're a firm believer in being in every part of our community. So we're actually everywhere in disguise. Technically, I work for a subsidiary of Wintrust because we're named by the communities that we serve, whether it's Clarendon Hills, Hinsdale Bank, Darien. We're all over the Midwest. We're now, I believe, the third largest regional bank in the Midwest, and we're continuing to grow with our customer service. So happy to continue the conversation with any of you. I'm really delighted that you took an hour out of your time to come and listen to me, and I'm hoping that it was worth your while. Again, I'm happy to discuss any of these topics at a later date.
Thank you so much, George, for being with us here today, for presenting, sharing all of this great information. I did get a couple people in here dropping in saying thank you so much, very informative. And just as a reminder here, we will be sharing the recording of this webinar along with the slide deck. I know some of you may have joined us a little bit later, so don't worry, you will get everything. I plan to send something out by the end of this week. And if nobody has any more questions, we'll give you back the rest of your day. Thanks again for joining us. Thank you again, George.
Thanks, guys. Thanks, everyone.
Have a good one.
Alrighty, bye.
Bye, George.